Yeah, I promise. Yeah. Hello, can you hear me? Yeah, hello, can you hear me? Hello, can you hear me? Hello, promise. Hello. Hello. Yeah, can you hear me? Hello. Hello. Yeah, can you hear me?
Yes, I can hear you, Mr. Wilson.
What happened before? Hello.
I signed up and I didn't open the video and audio.
Okay, okay, okay.
Yeah.
Okay. So this is recorded now. So let's just do a practice. Let me share my screen.
All right.
All right, can you see this?
Loud and clear, I can see it.
Okay, okay. Um, all right, so let me just run you through. Let me just quickly run through this. Are you with me?
I'm with you, 100%.
All right. Okay, so this is what we have for today. So here we have the financial statement, the integrated financial statement model. All right. So you see what we have here. We have the assumptions. You can see that this has already been formatted. So if I uncheck all this, so we have assumptions, income statement, balance sheet, cash flow statement, and the supporting schedule. So basically, what we want to do today uh, is to apply this forecasting factors on the historical financial statement. So we have the income statement here, we have the balance sheet, and we have the cash flow statement. Now, if you can see that there are some lines that we have highlighted in yellow. So these are actually key because we're going to be making reference to the supporting schedule, filling these lines. right?
Okay.
So let me
Yeah.
start with the revenue. So for revenue, of course, we have the revenue assumption, which is revenue growth percentage. So what we do here is simply to say revenue. All right. So we're going
Yes.
to pick the historical number, the prior year end, the immediate prior year end, which is 2016. So we're going to pick 2016. I'm going to say time. All right.
Okay.
Okay. We're going to open the bracket. I'm going to pick the forecasting factor plus one. Then we close
Okay.
it. That's the formula we have. Then we press enter. So once we do that, and press uh, Control Shift, then Control R. I believe it. So that's for the revenue. Then for the cost of goods sold, the cost of goods sold, we also have the percentage given for the cost of goods sold. So what we're just going to do is we're going to forecast this as well. We are told that cost of goods sold is a percentage of the revenue. So what we're going to do is to pick the revenue, then we say times, then we go ahead and apply the percentage for revenue. That's 37%, right? So that's
Okay.
37%. All right. So we just take this down. So that's all for cost of goods sold. Now for gross profit, that's quite straightforward. It's just to pick this minus the cost of goods sold. So once you pick that, you take it down. All right. Now, for salaries and benefits. Now, salaries and benefits, we are giving salaries and benefits to be a percentage of revenue. All right. So these are historical numbers. We don't have anything to do with historical numbers. So we are dealing with forecast period. We are dealing with forecast period, not historical number. Normally, when you want to do financial statement forecast, you would have been giving annual reports. I told you the last time, the last class, we discussed about reporting model. So this is as it is now. This historical result is a reporting model. It is when you start doing forecast that it becomes a forecasting model. So this is actually a financial statement forecast because we are having forecasting period. So this is a reporting model. So let's proceed. Now, what we have here is salaries and benefits. So for salaries and benefits, how do we forecast that? We have the forecasting factor as a percentage of what? Percentage of revenue. And if you see what we have here, we have been giving the numbers in absolute terms, meaning we are not giving any percentage. So we are not applying any percentage here. So what we simply do is to check this and go up and go and click 25,000, press enter, then you can take this down. Great. So that is for salaries and benefits. Then for overheads, rent and overheads is the same thing. We have been giving rent and overheads in absolute terms. You can see that this is in thousands, 10,000. So we pick this and we drag to the right. All right. Now, I told you that this place is colored, this place that is colored in yellow. It's always like that for financial statement forecast because here we have depreciation and amortization. Now, this depreciation and amortization, if you check what we have in the assumption, I want you to take note of this. Now, if you check what we have in the assumption, you will see that depreciation and amortization is to be taken as a percentage of plant, property, and equipment opening balance. The same
Okay.
thing for interest as a percentage of debt opening balance. Now, if you check this financial statement, of course, you see that there is no opening balance for PPE and no opening balance for debt. So what we have to do now is to go to the supporting schedule. Now, if you come to the supporting schedule, you will see that the supporting schedule has input for account receivable, inventory, and account payable. At the same time, it has for net working capital and change in net working capital. It also has for depreciation schedule and debt and interest schedule. So now, what we're going to do first of all is to leave this place blank. Just leave this place. We're just going to leave this place first and go to the other ones that we can compute. Then later on, we'll come back to depreciation and interest. All right. So the next thing we're going to do here is to calculate our total expenses. Our total expenses is the sum of all the expenses that we have here. All right. So the sum of all the expenses that we have here. So I'll just take this down. All right. So I'm taking that down to have the total expenses. Then earnings before tax, of course, earning before tax will give you your gross profit minus your total expenses. That's pretty straightforward. That's pretty straightforward. Now, the next thing is our taxes. Of course, we have been given assumptions for our taxes. We're told that our taxes is uh, 28%, 28%, I think 28% flat for the forecast period from 2017 to 2021. So we're just simply going to apply that. Note that this figure might still change because this is a function of earnings before tax. And earnings before tax will change when we have depreciation and amortization and interest included here. But for now, we can have the formula here by saying you are picking EBT times. We'll go up to the assumption. We go up to the assumption and go and pick our tax percentage. Press enter. So I'm just going to take this down. All right, so that's what we have. Now, our net earnings is simply going to be our earnings before tax minus our taxes, which is age 39. Okay, so we have our earnings, our net earnings there. Then we take this down. All right, so we go to the balance sheet aspect. For the balance sheet, of course, we have our assets. All right, we have our cash. Now, this cash, you can see that I've made this one to be green, meaning that we're going to leave this for now. So we are leaving depreciation and amortization, interest, and we are leaving cash. So we move straight to accounts receivable. Now, what do we do here in accounts receivable? Now, you have to take note of the fact that accounts receivable is a function of your sales. Accounts receivable is a function of your sales because it's what you expect to collect from your customers. Okay, what you expect to collect from your customers are your receivables. Now, if you go up, you see that in the assumption, you have been given account receivable days. All right. So what we're simply going to do to get our account receivable in the balance sheet is simply to take our revenue, we go up to the income statement and take our revenue, then we multiply this by, we also go up, okay? We go and pick our account receivable days, all right? Then we divide this by 365. Press enter. So this gives us our account receivable forecast for 2017. Now, what this one simply means is, or the rationale behind this formula is, when we have our account receivable days, it stands for the debtors amount yet to be collected, the customers amount yet to be collected. So if we have an outstanding days or collection days of 36 days or 18 days, what we're simply going to do is to take a fraction of that from 365 and multiply by the revenue for the forecast year for us to be able to get our outstanding receivables at the end of that year. So that's the rationale behind that formula. So what we're simply going to do here is to drag this down and we have our account receivable. Now for inventory. Now inventory is going to be a function of cost of goods sold. It's similar to how we did it for account receivable, just that this time around we are picking cost of goods sold. So what I'm going to do here is to go up. I'm going to pick my cost of goods sold. All right. I'm going to say times. Then I will also go up. I will also go up and pick my inventory days. I'll pick my inventory days and divide that by 365. That's 365 days, making the calendar year. So I press enter, all right, then I drag this down. So with this, we have been able to forecast successfully our accounts receivable and our inventory. Now, also take note of the fact that this property and equipment is also in yellow. Why is it in yellow? Because we actually do not have any assumption here that says this is our P, T, and E. All right, so we're going to obviously get this from our supporting schedule. Okay, so it's going to be the ending closing balance for property and equipment at the end of each of the forecast years. So what we're going to do here now is to simply have a formula where we have the total assets. We have the total asset there. Press enter. I take this down to the left, so to the right rather. So we have the total asset there. Now the next is to calculate our account payable. Our account payable. Now, of course, our account payable is also going to be a function of our cost of goods sold. So first thing is to go up, you go and pick your cost of goods sold, you pick your cost of goods sold, then you say times, all right? Now you go ahead and pick your account payable base. You have our account payable base here, all right? Then you say divided by 355 and you press enter. So the same principle applies. The principle that applies to where we take the one for inventory, same thing we are doing here, all right? Because of course we are buying our inventory from our suppliers. So that's why it's also applicable to account payable. So we take this down to the right. So we have forecasted our account payable successfully. Now we are still going to leave this one yellow because we want to make reference to the we want to make reference to the supporting schedule for us to be able to arrive at this. All right. So what I'm simply going to do here is from these two, right? From these two, I have this. All right. So I take this down to the right. Great. Now the next thing is our shareholders equity. Now, for our shareholders equity, what we're simply going to do is to look at the movement. Of course, in the assumption, if you go straight to the assumption, you will see that there are movements. There are movements for the forecast period. Okay, for the equity issued, you see that the equity issued is nil for 2017, FY 2017 to FY 2019. When I use the word FY means for year end. Okay? In financial modeling, we always say the word FY. Okay, FY means for year end. When you hear the word FY, it means for year end. Okay, all right. So the E actually is not pronounced. So we just use FY 2017, FY 2019, FY 2020. All right. So for the equity issue, so what we're simply going to do is in our immediate prior year, we had 170,000 as value for equity, right? So what we're simply going to do here is to pick the 170,000, which is the equity at the prior year in 2017. Then we say plus, go up and go and pick the equity value. We'll go up and pick the equity equity value in the assumption. So the equity value in the assumption here is nil because we didn't issue any equity. We are assuming or we are making an assumption that there's no equity issued in 2017 and there's no equity repaid in 2017. So that is exactly what that means. Here I'll press enter and I'll simply take this down. Now, if you observe, you'll see that there are changes in this equity. All right. Now, for year end 2017 to 2019, it is constant. But from year end 2020 to 2021, it changes to 20. Why is that possible? Because if you observe what we have in FY 2019, you will see that in FY 2019, we made a repayment of equity of 20,000. So if you are making a repayment of 20,000 out of what was started with for the year end 2017, which is our historical result, you will see that it's going to be less. Okay, it's going to be reduced to 20,000 because we actually made a payment. Sorry, it's not this 20,000. We actually made a repayment of equity in FY 2020. Please, it's not this 20,000. This is actually debt issuance. So I'm making reference to FY 2020 and equity issued and or repaid. So repaid is in bracket, that is negative. So negative 150 here is what gives us 20 here. So 170 is reduced by 150 because we paid equity holders and we are having 20,000 naira, 20 million naira left. Assuming this is denominated in million, 20 million naira left as equity. All right, fantastic. Now we move to our retained earnings. For retained earnings, it's also very straightforward. It's going to be the retained earnings for the immediate prior year plus. Now you go up and you go and pick your net earnings. When you pick your net earnings here, you just say plus. Mind you, this figure is still going to change by the time we start imputing depreciation and amortization and interest. So what we're going to do here now is to what we're going to do is just come and take this down and take this down. So great. So we've been able to complete our retained earnings. So the next thing for us to do now is to calculate our shareholders' equity. So for our shareholders' equity, we simply say sum. All right. So we pick these two. Okay. Immediately we do that, we drag down. So this is our shareholders' equity. Now, for total liabilities and shareholders' equity, it's straightforward. We're simply going to pick our shareholders' equity, which is H58, H58 plus our total liabilities. All right. So we take this down. So that's what we have. Now, if you take a look at what we have here, all right. So I'm simply um, going to explain what this formula means here. So if you check this formula, you see that this formula is an if error formula. In the last class, we made mention of if error. So what this one means is, okay, we're actually using this to check the accuracy of our balance sheet. We are using it to check the accuracy of our balance sheet. Now, what this formula simply means here is we are taking the absolute of H60 greater than 0, meaning if H60, which is the value that we have here, H60, if H60 is negative, it's going to change it to positive. That is what this means. Absolute means changing a positive number, a negative number to positive. All right. So if this is true, okay, it tells you error. It is true, meaning that if this is greater than 1, it's an error because the balance sheet will not be balanced. But if it is less than 1 or equal to 0, it is okay, meaning that the balance sheet is balanced. But if in any way this formula returns an error value, then it's going to tell you it's also okay. All right, so that is what that formula means there. All right. Now, we may not want to complicate things by having a long formula like this. That will be issue. In some instances, you may just want to say that the debit side, for instance, if you have the total of the assets to be 10, I have the total of the liabilities to be 10. I just want to make an example here. I can as well just say this equals then equals this. So this is still going to tell me true. So if I had that formula here, this would have been true. But the disadvantage of actually using this is that in case there are approximation errors in your balance sheet, okay, this formula is going to tell you false. For instance, if I come here and say 10.5, it's going to be false. It's not true. But 10.5 is not exactly equal to 10. All right. But for this, but for this function, but for this function that is here, it will actually give you an approximate number. Once you have an approximate a value that is due to approximation error, it's still going to return okay. So that's what we have there. Now, as we were saying, now we have cash also in green. So we're going to leave this for now. Property and equipment, we're going to leave it for now. Debt, we're also going to leave it for now. So what we're going to do now is, if you observe, you see that we have completed all the aspects in the balance sheet and income statement, except the ones highlighted in yellow and green. And I told you that the reason why we are highlighting those ones in yellow is because we don't have the assumptions given explicitly in our case study. So what we're going to do here now is to come down to the supporting schedule. So if you come here, now we should have the supporting schedule. So this is the supporting schedule. This is the supporting schedule. So what we want to achieve here in the supporting schedule is to be able to get our PPE and our debt opening balance, the basis on which is applied the percentage given in the assumption in order to complete our income statement and balance sheet. So what we're going to do here is we have calculated our account receivables already. So I'm going to go up and just pick account receivable here. I'll press enter. All right. What of inventory? Of course, we calculated inventory. I'll go up to the balance sheet and pick this and say enter. Now, last is account payable. Of course, we also calculated account payable. So I'll go up and go to account payable and press enter. Great. Now, what I'm now going to do here is to get the net working capital. So, how do I get net working capital? Please ensure you take note of this format. For you to get your working capital schedule, start with your account receivable. Of course, if you have any other current liabilities there, you can pick that as well. Then you have your inventory, you have your account payable. All right. So, for us to get the net working capital, it's simply going to be the account receivable plus the inventory, all right, minus the account payable. Of course, you know that the formula for working capital is current assets minus current liabilities. Both account receivable and inventory are current assets, while account payable is a current liability. So if we have that, we have our net working capital as 313,584. All right. So the next thing we're going to do here is to find the change in net working capital. It's going to be this minus this. All right. So what we're simply going to do here is I'm going to highlight everything now. Okay, follow me. I'm highlighting everything and I'm pressing control. Okay, I press control. All right. So wait, hold a minute. I'm highlighting everything and I'm holding on shift. So I hold on shift and I press this and I'll press control and R. All right. So that's how I'm able to populate everything. I will do that again. So I'm highlighting everything here. I will press shift. All right. Then I'll press the right arrow key. Right arrow key. I will press control and R. So that's how I got that. So that is solved for the working capital schedule. Now the next thing we'll have is the depreciation schedule. How do you get your depreciation schedule? It's very straightforward. It's simply, of course, we have the PPE opening, we have the capex, we add the capex to it, capital expenditure for the year, and you less depreciation. All right. Now, the PPE opening for the forecast year 2017 is going to be the closing for the immediate prior year 2016. All right. So we pick that. Now, our capex, of course, if you go to your assumption, you have been given the capex for the year in your assumption. All right. So you look at it, this is it, 15,000 capital expenditure, 15,000. All right. Okay. Now what do we have? Depreciation. Depreciation. Now if you check, you will see that in your assumption, you have been given the depreciation percentage as 40%. And they said that the depreciation is a percentage of PP&E opening balance. So what we're going to do is to say 40% times, all right? So we go ahead and pick the opening balance for PP&E, which is 37,522, and press enter. All right, so that's just what we have. Now, how do we now get the closing PPE? It is simply the opening plus the plant, property, and equipment that we started with at the beginning of the year, plus what we bought during the year, minus the depreciation during the year to give us the closing. So fine. So what we're just simply going to do here is similar to what we did before. I'm going to highlight everything. I've highlighted everything. I'll press shift and I'll press this. I'll press control and I'll press R. So that is it for the depreciation schedule. Now the last one is the debt and interest schedule. It's similar to what we did for depreciation schedule. Now the opening balance for FY 2017, I'm going to be using FY here instead of saying for year end. So get used to saying FY. So the opening balance for FY 2017, which is the forecast period, is going to be the closing balance, the debt closing balance at the immediate prior year. All right, so I'm going to pick that. Now, the next thing I'm going to do is to say equals to. Now we have the movement for debt and interest. The movements for debt during the year. So whether we have issuance or repayment. If we have issuance, it means we have more debt. If we are repaying, it means our debt obligation is reducing. So we have to go up to our assumption and see what happens. So we go up to our assumption and pick this. Okay, we pick this. Can see debt issuance or repayment. So we pick this for FY 2017. Okay, so then the next thing we're not going to do is to say this. We simply add this. Okay, just take this down. Just say some and take that down. All right. So What you're not going to do here is the interest expense. Of course, we've been given the formula for interest expense. They said that interest expense from our assumption, the interest expense has been given in our assumption. Look at it here. Now, the interest expense is the percentage of the debt opening balance. You can see the reason why I'm putting all these things in yellow. The percentage of the debt opening balance. So we say times, then we come down and pick the opening balance for debt, which is this. I'll press enter. Immediately we do that, do the same thing. Hold on shift. All right. Let me do that again. I'm highlighting everything. I'll press shift and I'll press the right arrow key up to FY 2021. I'll press control and we'll press R. So that's what we have there. All right. So with this now, you can see that what is left now. So we have depreciation and interest. We have cash. We have PPE, and we have debt. Very straightforward. This is very systematic. So you should follow this step in preparing a forecasted financial statement. So what we're going to do here is let's now populate what we have in yellow and in green. For our debt, for FY 2017, our debt, of course, is going to be the closing for FY 2017 based on our supporting schedule. Based on our supporting schedule. So I'm going to pick this. I'm going to pick this. So this is debt closing, and I'll press enter. Great. I'll press enter. I don't need to stress myself. Just drag down up to this list. All right. So we're done with debt. So we come to PPE. PPE is the same thing. You go to your supporting schedule. Go to your supporting schedule, which is the closing, and press enter. Great. So what we're going to do now is just take this here. Fantastic. Now, not the last. So we still have this. We have depreciation and amortization. Depreciation and amortization in our income statement. All right. So that's pretty straightforward. But we can pick our depreciation and amortization from our depreciation schedule. So let's go to our depreciation schedule. So we have depreciation here. So that is what we have. Great. So here, we take this down. Fantastic. So the last one is interest. Now we come down to our supporting schedule again. Come down to our supporting schedule and come and pick interest here. So this is interest here. And we press enter. All right. So very simple. We just take this down like this. Fantastic. So what is left is our cash. Our cash. This is the only thing left. And this is that's why I have to separate this by putting it in green. This is the final thing that you do in any forecasting model. This is the final thing that you do. So how do you get this value? You just simply go to your cash flow statement. Go to your cash flow statement. So this is your cash flow statement. This is your cash flow statement. All right. Now, that reminds me, for the cash flow statement, you also equally need to complete the forecast period. Okay, it's very straightforward, right? Now for the cash flow statement, of course, what we're going to pick here is first of all the net earnings. The net earnings as per the income statement. You come here and pick the net earnings. Great. Now, what else are you picking? Plus depreciation and amortization. Where are you picking that from? You also go to your income statement. Depreciation and amortization. Great. The next thing is change in working capital. Now, for change in working capital, of course, we did that here. Our supporting schedule. Okay. So we did that here. This is our change in working capital. So we have our change in working capital there. Sorry. So that should be the net change in working capital. Sorry. So the net change in working capital. So we have the net change in working capital here. All right. So what we're simply going to do now is to picking all this. Okay. First of all, we had this plus this, all right, then minus, of course, change in working capital, which is this. So we have that. So we're going to highlight everything here, all right. We're going to press Shift and this and R. So that's what we have for that. So the next thing is investment in property and equipment. Of course, that's our capex. From our assumptions, we have our what? We have our capex. So we pick our capex. Okay, so we have that. So the same thing applies here. You can just take this down. Okay, it's equals to. You can just take this down. Same thing applies. All right. So now for financing cash flow, okay, we pick that straight up from first. Pick that straight up from the assumptions for the forecast period. All right. So the first one is for debt. When we take it down, the second one is for equity. So we can take this down like this. All right. So we can just have this as one. Okay. So let's go back on the line. All right. So that's what we have there. Now for our net increase or decrease in cash, it's simply going to be the cash flow from operations. We pick the cash flow from operations. All right. Now, cash flow from investing is an outflow, so it's going to be minus. All right. Now, cash flow from financing is an inflow. It's going to be plus. Then we press enter. All right. Now, the opening balance here is the closing balance for the immediate prior year. So that's what we have there. All right. So next thing is for us to simply add. So we just add these two numbers. So we have that. So we can pick this Shift, Control R. So that's what we have there for our net increase that's decrease in cash. So that's what we have there. So the final thing we now pick is just go ahead and pick this. Okay, so we made not necessarily copy. So just come here and say in cash, just say equals to, then you come down and pick your closing balances. All right, then you take this down. So that's the final stage. So here, so what happens here now is to come here and take this down like this. Now, if you observe something here, you see that what we have here is we are having for the check, we are having 0.9. So this 0.9 that is here is just approximation error. It's just approximation error. So basically our total asset, which is this, and our total liabilities and shareholders equity, which is this, is to a whole number the same thing. So what we just basically have here is approximation error. So that is it. So you can see that here our balance sheet is saying okay, meaning it is fine. Okay. If I remove this, for instance, if I remove this, if I take out this, you can see that it's telling me error. You can see that here it's showing error. You can see it's showing error here. I may decide to do something here. Okay. I may decide to apply conditional formatting here, for instance. Okay. And say text that contains error. So you can see that it's showing error. But immediately I come here, I pick the come to the cash flow. I pick the closing cash balance, copy it, then come up and paste it here. We have it to be okay, meaning our balance sheet is fine. All right, so this is what we have. Hello, promise. Hello?
I'm with you. I'm with you. Hold on. Hold on.
All right, so this is what we have for the forecast. All right, so there's some other things you can do. So the first thing is, so successfully we have been able to forecast. We have been able to forecast this financial statement, right? We've been able to forecast the financial statement successfully. Now, the other things you can do to this financial statement, of course, you can be asked to do. You can be asked to do a sensitivity analysis. All right, you can be asked to do a sensitivity analysis. How do you do that? That's straightforward. All right, so that's straightforward. So when we say sensitivity analysis, basically, you are trying to see what is the response, what is the sensitivity, or the impact, okay, of each of the lines or the lines in your financial statement on a given variable. It could be the EBITDA, all right? It could be the EBITDA. Okay. So that is basically what sensitivity analysis is talking about. So let's see how we can apply just a simple sensitivity analysis to this table. All right. If I come here, and I want to calculate EBITDA here, and I want to calculate EBITDA here, what I was simply going to do, EBITDA, of course, this is EBITDA. I'm going to type something here. EBITDA. Let me let me bold this for you. EBITDA. EBITDA means earnings. It means earnings. Earnings before interest, tax, depreciation, and amortization. That is what EBITDA means. Earnings before interest, tax, depreciation, and amortization. Okay. Apart from EBITDA, we also have EBIT. We also have EBT. We have PAT. But out of all these performance metrics, EBITDA is the most used. Okay. In fact, if you want to know the operating performance of any company, what you're going to look at is just take a look at the EBITDA. Now, what is the logic behind EBITDA? The logic behind EBITDA is sometimes management will want to know the performance, the performance.
I'm with you.
All right. So sometimes management will want to know the performance of an organization, and in terms of performance, they want to say you take out the interest attributable to those who have financed the company with debt. All right. Take out your obligation to the government. Take out the fact that your assets, the asset used in your business, is subject to depreciation, and take out the fact that you have intangible assets such as goodwill in your company that you amortize on a monthly or on a monthly basis or yearly basis. And what we just want to know is we want to know the operating performance of this business. We want to know the operating performance of before considering interest, tax, depreciation, and amortization. So include EBITDA here. You can simply just come here. I will just insert a line here. It's very simple. I will just insert a line here and say EBITDA. EBITDA. All right. So I'm inserting a line there and say EBITDA. I can put that in red. All right. So start the line there and say EBITDA. So how do you calculate your EBITDA? Now, of course, for the historical result, your EBITDA is going to be, of course, your total expenses. Sorry, it's going to be your gross profit minus some, and you pay your salaries and benefits, rent and overhead, and you press enter. So this is the EBITDA. This is the EBITDA, earnings before interest, tax, depreciation, and amortization. You can see that depreciation and amortization is here, interest is here, and tax is here. So this is earnings before considering these three. Okay. Before we consider these three things, we have EBITDA. All right. So I can just take this and drag down all through. Great. So we have calculated our what? We have calculated our EBITDA. Now, earnings before tax, of course, earnings before tax is going to change. The formula is going to change here because EBITDA is affecting it. You can see because this is actually this number here, 84984, is speaking EBITDA. So what we're going to do is simply our earnings before tax, this formula is going to change. So our earnings before tax is just going to be the EBITDA, of course, minus the depreciation minus interest. All right. Yeah, that's all. Minus the interest, and you press enter. So this is earnings before tax. So you can see that tax is here. Tax is here. Tax is here. I will give it another color. Tax is here. All right. So you take this one down. Fantastic. So that's what we have for earnings before tax. I mean, just represent this one with EBT. Earnings before tax. And as well just put it in this. This. All right. So we've calculated our EBITDA, and we calculated our EBT. Now, another thing that is always calculated, performance metrics, that is also always calculated is EBIT. EBIT is, I have to put this down, EBT. These things are important. So these performance metrics are important. Earnings before earnings before tax. All right. So EBIT is earnings before interest and tax. So this is EBIT. EBIT is earnings before interest and tax. So it's very important that you know all this. So our EBIT, okay, so it's better we put it here. Sorry, I can delete this. Now I'm going to put it here. So our EBIT, so each of these actually belongs to different school of thought. They actually belong to different what? They belong to different school of thought. Those who support that EBITDA is a better performance metric, EBIT or EBIT is a better performance metric. They are different school of thought. So I'm going to explain those school of thought later on and what they believe in. But now let's just have this noted. All right. So for EBT, earnings before interest and tax, of course, it's going to be okay. We have our EBITDA. Now, in this EBITDA now, okay, EBITDA is earnings before interest and tax. So what we're going to do here is just to add depreciation and amortization to get our EBIT. Very straightforward. Just for you to add depreciation, because if you are saying it means you are removing the D and A, depreciation and amortization. So if you are removing it, any before interest and tax is simply to add back. So just add back. Okay. Of course, we haven't taken out interest. Assuming interest is there, we would have added back interest as well. So we take this all down. So that's what we have for that. All right. So what we simply want to do here is you can take note of this. Okay. So it's not going to make our financial statement model look professional. So I'll just take it out. All right. So now what we want to achieve here, you can see that this is not affecting our balance sheet because our balance sheet is still balanced. But okay. All right. So what we're going to do here next is to let's see if we can do some sensitivity analysis. So let's see if we can do some sensitivity analysis here. So we're going to see how we can do sensitivity analysis. Now, sensitivity analysis can be a two-way factor or a one-way factor sensitivity analysis. The two-way factor sensitivity analysis means you are taking into cognizance only one input. Only one input. But for a two-way factor, we are taking into consideration two inputs. So we see how we do that. Now, let's say we want to do sensitivity analysis for EBITDA. EBITDA, right? Now we want to see how sensitive is revenue, how sensitive is our revenue to EBITDA. How sensitive is our revenue to EBITDA? Now, if you ask me that question straightforward, I will just tell you that revenue is highly sensitive. EBITDA is highly sensitive to revenue. EBITDA is highly sensitive to revenue because if you change your revenue or if your revenue changes by a particular number, it's going to have a significant impact on your EBITDA. All right. So what we're going to simply do here is, now we're going to have a simple table here. Okay. We're going to have a simple table here. All right. Let me see. I can decide to add another line here. All right. So we have the EBITDA here. Now, what we're simply going to do is here. Let me take this out from here. Let me take this out from here and have it here. All right. So I'm taking it out from there and I'm having it there. And what I want to do now is to centralize it, merge and center, and put it in the center. Okay. Can decide to add one more extra line. Let me take it down a bit. I can have something like this here, merge and center. I can have revenue. All right. So we do have a forecasting factor for revenue. So it's going to work. So let's see how this goes. Now for EBITDA, to make this straightforward and to prove a theory for you, to prove a fact for you, what we're going to simply do here is we're going to pick EBITDA for 2017. No, let's pick EBITDA for FY 2017, not 2016. FY 2017. I'm going to pick this EBITDA. I just want to show you something. Sorry, I'm going to paste it. Please ensure you leave a space here. Let me highlight this. Ensure you leave this here. So I'm going to paste it here. I just copy something now. So I'll copy this. Okay, I understand. So I'll copy this and then I'll paste here. Great. All right. So what I'm simply going to do is I'm going to assume EBITDA of 70,000 here. I'm just assuming these are random numbers. I'm assuming random numbers. Okay. I'm assuming random. Okay. I'm assuming random numbers there. So I'm going to pick this. I'll drop this. Okay. So these are random numbers. 60, 56, 700, 70, 800, 20, 800. So these are random. They are just random numbers, right? They are just random numbers. So I picked random numbers here, except this that is not random, because this is actually based on what we actually calculated. All right. So all right. So that's the first thing we want to do. Let me just take off this. All right, it's fine. All right. So this is what we want to do first of all. Now let me also assume that I'm going to pick what we actually forecasted here as revenue. We actually forecasted this as revenue. Um, okay, it's fine. So what we're simply going to do, we assume random numbers. Okay, so so we assume random numbers there. All right, so we assume random numbers there. Now, sorry, this, okay, I should highlight this. I actually want to center that properly. Uh, that works. Okay, it's fine. Doesn't really matter anyway, but I think there is fine because we're actually trying to pick the number here. So by the time we are highlighting, we know exactly what we are picking. So, sorry, this should be here. Please take note of what I'm doing. It's very important that you structure this table properly. Yes, it's fine now. It must exactly be here. This must be here. So it's very important the structure. Otherwise, what you want to do will be wrong. What you want to do will be wrong. All right. So that's what we have. So we've set up our sensitivity analysis table. It's actually called a data table. Sensitivity analysis. All right. So sensitivity analysis. So what we're going to do here is, of course, we calculated EBITDA. We calculated EBITDA here, right? We calculated EBITDA here for the forecast for FY 2017. This is the EBITDA. So you select that. You can see I'm just saying equals to, I'll come and pick the EBITDA. I'll come and pick the EBITDA for FY 2017 and press enter. That's the first thing I'll do. All right. So what I'm going to do here now is I'm going to highlight everything that we have here. See that? Then I'm going to come here. I'm going to come to data. I'm going to come to what if analysis. I'm going to select data table, right? So I'll select data table there. Now, data table, row input cell, row input cell, row input cell. Now, this is the row. The row is the revenue. So we go up and pick the revenue. Where do we have the revenue? Of course, that's the forecasting factor. We pick this, then column input. Column input is the EBITDA, isn't it? Column input is the EBITDA. So we come here. Where do we have the EBITDA? The calculated EBITDA, income statement. So this is EBITDA. So that's the calculated EBITDA there. So we don't actually have a percentage for that. So I'm just picking that number straight up. All right. So I'm going to press OK. So once I press OK, I have this. So this is what I have. You can see what we have here. So here, now, this is what we call data table. And this is actually sensitivity analysis. This is actually what we mean by sensitivity analysis. Okay, because you can see that it's showing the response. Okay, what EBITDA would be, given that we have this different revenue. Okay, we have this different revenue. These are different revenue rather, and we have EBITDA amount here. So this is EBITDA, given that we have revenue to be 158,310.6. EBITDA is 64,735. All right. Now, in some instances, most often case the case we have most often is the fact that we can have this EBITDA, for instance, let's say we have this EBITDA to be a percentage, okay? we have this EBITDA to be a forecasting factor. And what's the forecasting factor there? Is that it is a percentage, right? It's a percentage of the revenue. If I have something like this, okay, that's a percentage of the revenue, something like this. So what you will now pick here is 41%, rather than picking, the other time you pick 54, 54, 376. You just pick 41% as the column input. All right. So this is what we have for sensitivity analysis. The various combination of EBITDA and revenue. Okay, the various combination of EBITDA and revenue. Those you are sensitive, your EBITDA is your revenue. All right. So these are the revenue that we have, and these are the various EBITDA. These are the various EBITDA. You can see that when the revenue, is 158, EBITDA is 64,735. Exactly what we calculated. Exactly what we calculated. That's why I have to use that number. Exactly what we calculated. But if the revenue is 200, EBITDA is going to be 70. You can see that's the intersection. If the revenue is 150, EBITDA will be 70. So it's just like that. But this is actually constant. That's what we have. So basically, the reason why we're having most of this is as constant because we have picked a constant value as EBITDA. Okay? We have used a percentage such as this. Probably these variables there would have been more variance here. All right. So that's what we have for sensitivity analysis. Are you there?
Yes, I'm here.
All right. So we're going to end this here.
Okay. That's fine. That's fine.
All right. Thank you.
Yeah. Great job. Well done, boss.